rollout of vaccines is expected to boost global growth prospects generally. We have therefore revised global growth for 2021 higher. However, global distribution of vaccines is likely to be slow and could create an uneven pace of global economic recovery in 2021. The International Monetary Fund has forecast global gross domestic product to have contracted by about 4.4% in 2020 and to expand by 5.2% in 2021. Their new forecasts will be released on the 26th of January. While financial asset prices were volatile for much of the past year due to pandemic-related developments and geopolitical events, recent months have seen markets strengthen. Capital flows to emerging markets have generally picked up when compared to the outflows experienced in March and April this year. Although global policy rates look set to remain accommodative, risk aversion is likely to persist through 2021, particularly where economies fail to take advantage of improved global prospects or run large macroeconomic imbalances. In the third quarter of 2020, the South African economy grew by 66.1% quarter-on-quarter, seasonally adjusted and annualized, compared to the bank's expected 50.3% growth. The growth rate for the full year is now expected to be -7.1%, compared to the contraction of 8% expected at the time of November meeting. However, our projection for the fourth quarter of 2020 is expected to be lower than previously forecast. While lockdown restrictions currently in place are considerably less restrictive than in 2020, we expect growth in the first quarter of 2021 to remain muted. Despite very robust terms of trade and stronger exports, getting back to pre-pandemic output levels will take time. Sharply lower public and private sector investment last year and continued weakness in 2021 will weigh on growth prospects. GDP is now expected to grow by 3.6% in 2021 and by 2.4% in 2022. GDP growth of 2.5% is expected in 2023. Overall, risks to the domestic growth outlook are assessed to be balanced. Global growth, vaccine distribution, a low cost of capital, and high commodity prices are supportive of growth. However, new waves of the COVID-19 virus are likely to periodically weigh on economic activity both globally and locally. In addition, constraints to the domestic supply of energy, weak investment, and uncertainty about vaccine rollout remain serious downside risks to the domestic growth. Accommodative policies in many advanced economies and the improved economic outlook continue to support recovery in global financial markets and some strengthening in international capital flows. So far, this has resulted in a trickle of fresh capital flows to South Africa, and financing conditions remain uncertain as reflected in the exceptionally steep yield curve. These favorable global conditions saw the rand appreciate by 1.7% since the July meeting. Since January 2020, the rand has, however, depreciated by 8% against the US dollar and remains below its estimated long-run equilibrium value. The implied starting point for the rand forecast is 15 rand 70 to the US dollar, compared with 16 rand 50 at the time of the previous meeting. Headline consumer price inflation averaged 3.3% in 2020, in line with the bank's expectation, and is the lowest rate since 2004. The bank's forecast for 2021 is slightly higher at 4% and is 4.5% for 2022. The forecast for 2023 is 4.6%. Core inflation averaged 3.3% in 2020. The forecast for 2021 and 2022 are unchanged at 3.4% and 4% respectively. In 2023, core inflation is expected to be 4.3%. Despite an upward revision to potential growth, higher growth in 2020 and in 2021 implied a small narrowing of the output gap over the forecast period compared to the November meeting. Global producer price inflation, food price inflation, and oil prices have risen. A more appreciated nominal exchange rate in recent months is expected, however, to moderate some inflationary pressure. The overall risks to the inflation outlook appear to be balanced in the near and medium term. Local food price inflation is higher, but expected to remain broadly contained. The committee additionally notes the significant but likely temporary reduction in medical insurance price inflation this year. Given low pass-through, risks to inflation from currency depreciation are expected to stay muted. However, additional exchange rate pressures could result from fiscal risks. While there are no demand-side pressures evident, electricity and other administered prices remain serious concerns. Expectations of future inflation appear more stable after sustained moderation last year, although those of households continue to moderate from quite high levels. Market-based expectations for short and medium-term inflation have eased slightly, while longer-term inflation expectations remain higher. The committee notes that the slow economic recovery will help keep inflation below the midpoint of the target range for this year and next. Unless risks outlined earlier materialize, inflation is expected to be well contained in 2021, before rising to around the midpoint in 2022 and 2023. Against this backdrop, the MPC decided to keep rates unchanged at 3.5% per annum. Two members of the committee preferred a 25 basis point cut, and 3 preferred to hold rates at the current level. The implied policy rate path of the quarterly projection model indicates 2 increases of 25 basis points in the second and third quarter of 2021. Monetary policy has eased financial conditions and improved the resilience of households and firms to the economic implications of 2019, and continues to be accommodative. The steps taken by the bank have ensured adequate liquidity in domestic markets. In addition, regulatory relief provided to banks has sustained lending to households and firms. While monetary policy will continue to support the economic recovery, a faster growth rate depends on implementing prudent macroeconomic policies and structural reforms. Lower administered prices, and productivity-adjusted wage settings aligned to projected inflation would also generate important macroeconomic gains. Such steps will enhance the effectiveness of monetary policy and its transmission to the broader economy. Economic and financial conditions are expected to remain volatile for the foreseeable future. In this highly uncertain environment, policy decisions will continue to be data-dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on second-round effects. As usual, the repo rate projection from the QPM remains a broad policy guide, changing from meeting to meeting in response to new data and risks. This concludes the statement of the MPC, and we will now take questions which we will distribute amongst the MPC members. Since we are virtual, Thoraya will pick up the questions from the chat and will then field them to the MPC members. Thoraya?
Thank you, Governor. I've got 4 questions. The first one is from Olivia Kamwendo from Reuters. Given that the growth outlook and worries about the impact of a renewed wave of COVID and restrictions on the economy, could the SARB not be more ambitious with monetary policy? I've got one from Lindley Donnelly from the Business Day. Given the growth outlook and worries about the impact of renewed waves of COVID and restrictions, sorry, my apologies, Governor. The question. Yes, I'll start again. The question from Olivia was, what are the risks to the inflation outlook? The question from Lindley was the one about the growth outlook and worries about the impact of renewed waves of COVID and restrictions on the economy. Could the SARB not be more ambitious with monetary policy? I have one from Prinesha Naidu from Bloomberg News. The monetary policy review released last year by the Reserve Bank stated that economic prosperity is a team sport, in quotes, and the central bank is just one player with a relatively narrowly defined role. Who are the other players and what should they be doing? Has the SARB factored the government's vaccine plans in its model? And if so, what kind of impact has this made on your outlook and your forecasting? And then a last question from Claire Bissiker from the Financial Mail. To what extent do you expect SA's fiscal situation to act as a handbrake on your ability to offer any further potential rate cuts this year? Another question, developed country central banks are likely to keep running exceptionally accommodative monetary policy this year. What are the implications for the South African economy as well as the SARB regarding the conduct of monetary policy? Those are the questions I have. Thank you.
Thank you very much for those questions, Olivia. The second wave is here with us, and in our forecast, we take account of the second wave, and don't take it that the second wave would be the last wave. There is a risk that you could actually have the third wave, depending on how the pandemic evolves. Could the SARB be more ambitious? I think the SARB has been very ambitious, not actually, let me just even say ambitious. We have been very aggressive in our response. The lag between monetary policy actions and impact on real economic activity vary between 12 and 18 months. It's hardly 12 months since we took our first steps. And the effect of those couldn't be immediately felt because the economy was under lockdown. So it was like the economy's handbrake was pulled up and the SARB was busy trying to press the accelerator. The car couldn't move. But the lockdown restrictions have since been relaxed, and the effects of these actions should filter into the economy. And we expect that the outlook that we have put now, which is significantly better than what we had put in November, takes account of that. That said, there are still risks to the economic outlook. Like I had said, what would happen to if we get a third wave, for example. At the moment, the restrictions that have been reimposed as a modified level 3 lockdown are not as severe on the economy as what we had seen before, and we think that the supply side of the economy should be able to cope. But just the mere existence of the lockdown does have impact on confidence, business and consumer confidence, and could affect the spending side of the economy. Prinesha, and then Olivia, there's also a question about the risks to the inflation outlook, and I think that we have spelled those out in the statement, but let me just reiterate them, is a rise in global producer price inflation, rising oil prices will play a role, and of course, rising global food prices that we have seen. In a way, South Africa is sort of like cushioned because we have got an expected bumper crop this year, which should help to moderate the impact of rising global food prices. But those are the risks. Prinesha will ask the question about who are the other players in the growth. Is all of those government agencies and government that are responsible for the structural reforms that are required to lift the potential growth rate of the economy. And in addition to that, linking to the question that Claire had raised, fiscal policy settings actually matter, that the fiscal stance itself impacts on growth, and what the fiscal authorities do is very important. And that is why we had also highlighted the fact that unless the evolution of fiscal policy is seen to be prudent, it could pose a risk to the nascent recovery that we had seen, and could actually also pose a risks to the exchange rate, and through second round effects could thus impact on inflation. Prinesha, you also asked the question about whether we had factored in the vaccine plan. No, we have not factored that as yet, because the plan got announced at the time we were way down with our forecast. But we did factor those into the global growth outlook, and that's because many of the forecasters of global growth said that they had factored it in globally, and they thought that it would have a positive impact on growth. Should a vaccination plan in South Africa be implemented judiciously, it should have a positive impact on the economy. What is in no doubt is that to the extent that there would be costs to the vaccinations, the economic benefits of a healthy population would far outweigh those costs that would be incurred in rolling out a vaccine. Claire also asked the question about the developed markets. We do allude to the fact that we expect that global financing conditions would remain accommodative, and actually all of the G3 economies that indicated that they are expecting to keep accommodation for longer. And if that accommodation is kept for longer, we expect that there would start to be capital flows to emerging markets like we started to see towards the end of last year. And if indeed those capital flows do take place, those capital flows, we expect them to be discriminatory. What do I mean by that? I mean that those flows will go to those countries with prudent macro settings. And as such, it is very important for South Africa to have very prudent macro settings so that we could access that capital, so that we could finance our own investment requirements. These accommodative settings, we also expect that they should benefit the global growth, and it should benefit growth in those developed markets. To the extent that that happens, what we have also seen for South Africa has been that there is a rising commodity price cycle. And that commodity price cycle has actually resulted in South Africa having a positive terms of trade shock. In other words, the prices of South African commodity exports has risen faster than what the prices of South African exports, and that is a net benefit for South Africa. And if South Africa takes advantage of that, we would actually see the growth outlook surprising on the upside. For now, we are saying that we see the risks to domestic economic growth as being balanced. That deals with all of those questions. MPC members, anybody wants to add anything? Nada. Okay, next set of questions, please.
Okay. Governor, we have a question. Governor, we have a question from Funeko, from Reuters. What does the MPC view as the largest fiscal risk? Have the risks of the second wave of COVID infections materialized much faster than you anticipated last year? Has South Africa's COVID vaccines added fiscal and policy risks? We have another question from Lamise at Fin24. What is the Reserve Bank's view on calls by labor unions to have a rate cut at this meeting to a question from Prinesha at Bloomberg. What were the reasons put forward by the MPC members who preferred a cut?
Thank you very much, Funeko. Yes, indeed, the second wave hit us earlier than we thought it would. We thought it would come after the holiday season, but it is here with us, and we're glad that government decided to take the appropriate steps to stem the tide. And what we see as the largest fiscal risks, we don't know until the budget is tabled. Once the budget is tabled, we would know what are the risks to the economic outlook. Calls by labor for a rate cut, they have been dealt quite extensively in the statement. We have stated where we see the risks. We still believe that the monetary policy stance is very accommodative. And just to put this thing into context so that you could appreciate this, that contemporaneously, if you look at the inflation figure released yesterday, you would say that with a repo rate of 3.5%, we are running a positive policy rate of just 0.2%. When you look forward, which is what matters, over the forecast period, you will actually realize that for all of this year and the next 2 years, the policy rate is negative in real terms. That means it is below the projected inflation. And in addition to that, the policy rate is below what we believe to be the neutral rate. And we have decided to keep it there precisely because we are worried about the state of the economy, one, but more importantly, that we actually do not see demand side pressures to the inflation outlook building up in this economy. And that has also dealt with reasons for those who argued for a cut. It had to do with the fact that inflation is contained and that the economy is weak and that we have got all of these risks. So in the statement, what you have is the arguments for a rate cut and the arguments for keeping rates the same. And on the balance of those arguments, the decision of the MPC was to keep rates the same.
Thank you, Governor.
Any other questions? These ones,
Yes.
I'm sure they are MPC members.
Yes, Governor, we have a question from Ed. What are the other handbrakes on the economy aside from lockdown measures? Lucanio from Business Day. How close is South Africa's debt to being unstable? Do you foresee the SARB having to increase its activity in the bond market to something that's more aggressive than what was seen in 2020 and more like the QE seen in developed markets? Fifi from CNBC. Could you please list the main reason why two of the MPC members preferred, you've already answered that one, Governor, preferred rates to be cut? Are these the same two members from the last meeting? How does the SARB see the risks? This question is from Prinesha. How does the SARB see the risk to fiscal dominance? And what is the extent to which the deterioration in public finances and rising government debts affect monetary policy? Governor, can I add one more from an analyst? It came in earlier. It's Pedro.
We are having a meeting with analysts tomorrow.
Okay. Okay, those are all from media for now.
Thank you very much. DG Nigel, can you deal with all the other handbrakes on the economy? And DG Chasivana, if you could deal with the debt and the SARB involvement in there and whether we could be doing QE and that stuff. And the risks to fiscal dominance between Rashad and Chris Lowald, any one of the two. Shall we start with you? Yeah.
Sure. Thank you, Governor. I think we all forgot.
So we're going to head out of that crossing then, of course, to the Reserve Bank Governor as he details the Monetary Policy Committee's decision then to keep interest rates unchanged. The repo rate remains at 3.5%. The prime lending rate stays at 7% then South Africa. So that is the state of affairs then from the Reserve Bank. Of course, we also do have that other breaking news, just to remind you then, the passing away, unfortunately, of the Minister in the Presidency there, Jackson Mthembu. We'll try and get to grips with all of the news that has just come out as well over the last couple of minutes, and we'll unpack that for you next. Stay tuned.
My holiday was amazing.